For decades since they were privatized, the UK's public service providers have favored inflation-linked bonds as a cheap and easily accessible means of financing that's now coming back to bite as borrowing costs surge to a 16-year high, potentially putting the government back on the hook to clean up the mess. And UK companies are the biggest issuers of inflation-linked debt in the developed world, with more than £40 billion, 51 billion worth of the securities currently outstanding. Much of that total is linked to firms that manage Britain's water, energy supplies, railways, and affordable housing. While many of the companies are in private hands, if they come up against financing problems, the burden quickly falls on the government, which has a responsibility to ensure the vital services are being fulfilled. That's the last thing Prime Minister Rishi Sunak needs as he struggles to tame a cost of living crisis, industrial action, and the government on spiraling borrowing costs, which have pushed national debt above 100% of GDP for the first time since 1961. Investors are already in talks to raise more than $1 billion for Thames Water, the UK's biggest water company, which announced it was having trouble servicing its debts. Government believes the utility can raise the funds on its own without a bailout, according to a Bloomberg report. Last year, Bulb Energy Limited was nationalized after it failed to hedge against price rises. The Bulb bailout shows that the public, as ever, will be on the hook for these firms' failure, whether through the public balance sheet or as service users, said Adrian Bohr, Director of Research at the Commonwealth think tank. The justification for the returns is that investors are bearing risk. But it seems when public utilities and services are involved, it's all reward, no risk. And many of Britain's public service providers were sold to private owners by Margaret Thatcher's Conservative government in the 1980s in a bid to stimulate economic growth. Such companies opted to raise money via long-dated inflation-linked bonds because the securities were attractive to UK pension funds. Payouts on many pension schemes are indexed to inflation, and providers were assistants often prepared to accept a lower coupon for securities that offered protection against rising consumer prices. Many other investors avoid inflation-linked bonds issued by UK utility companies because the duration makes them volatile and there's little liquidity, according to Chris Bowie, a partner at 24 Asset Management, LLP. And the problem now is that a large portion of the outstanding debt is linked to the retail price index, an old inflation metric that includes mortgage interest payments and describes that has skyrocketed over the past 2 years to 11.3%. At the same time, the metric used to determine what some firms, such as water companies, can charge customers based on the consumer price index plus housing rents, which has also risen, but not nearly as much. And as long as the revenues and debt are linked to the same inflation index, there's no problem, said Paul Vickers, a utilities analyst at Bloomberg Intelligence. But a UK 60 water company's debt and interest are increasing faster than earnings and assets, hence financial pressure. More than half of the £60.6 billion of debt issued by water companies in England and Wales is indexed to inflation, according to Ofwat, the industry regulator for the process in the two countries. The sharp increase in the cost of goods and services meant Yorkshire Water's net interest payable in the 2021 to 2022 financial year more than doubled to about $590 million from a year earlier. Southern Oil Limited is suspending dividend payments until at least 2025 after its financing costs increased by more than 40% in the year to April 1st, largely due to the inflation-linked debt. Other public service providers, such as Network Rail, the National Railway Network Manager, have also recorded a substantial hit to their earnings because of the impact of consumer price rises on their inflation-linked debt. Inflation has risen more since the start of 2021. than in the 10 years through 2020, according to a Bank of England calculator. Network Rail recorded a £1.2 billion hit to its profits in 2022 from RPI-linked debt, while revenues remain roughly the same. The gauge has increased since then and is running over 3 percentage points higher than the more commonly used CPI measure. Perhaps the company replaces the bonds as they mature with government funding. Net cash generated from its operations after borrowing costs has remained steady at about £4 billion annually in recent years. A Network Rail spokesman said that all of the company's external debt would be replaced by government borrowing upon maturity, and that its inflation-linked bonds will not impact operations or investments.
Public services that want privatized are also struggling to adapt to higher borrowing costs following government cutbacks in recent years. Councils in England face a funding gap of almost £3 billion over the next 2 years, just to keep services at current levels, the local government association said on Tuesday.
All but essential spending will stop at Woking Borough Council after it filed a so-called Section 114 notice due to a £1.2 billion budget shortfall. According to council, reported its planned expenditure in the coming years is likely to exceed its financial resources. Most of its debt is short-term, leaving it exposed to current higher interest rates. And some local governments are reviewing their capital programs to make sure they're still affordable, and in some cases trimming those capital programs by taking out things that are no longer viable, said David Whelan, managing director at Link Group, a financial services provider that advises local authorities. What they're spending on now is what they call the basic needs around housing, education, environment, and easier within the boundaries of the local authority. And
housing associations, nonprofit organizations that receive some funding from the government to provide affordable homes are being stretched by a rise in borrowing costs and a decreased ability to cover their debt burden. If slowing property sales and falling prices are adding to the strain,
the association's interest cover, in measure of how easily our company can pay interest on its outstanding debt, averaged 87% over the past financial year. The regulators of social housing wrote in a June report, noting that this is the lowest figure recorded in the regulators' quarterly surveys. The metric stood at 150% just over 5 years ago. In the same period, the company's total agreed borrowing facilities rose 45% to £123 billion.
A few who have been raising funds on the bond markets for new development may find themselves overstretched, said Yolande Barnes, chair of University College London's Bartlett Real Estate Institute. And we might see some mergers as those with lower gearing bail out any that get into trouble. One default would massively increase the cost of finance for everyone else.